This conference will now be recorded.
So, welcome to the first webinar of our T-DEB Partnerships and Investment series. In this case, this first one is preparing you to meet investors for our showcasing event in March 2020. For this webinar, we have a couple of guests that I will introduce briefly, but first I have a couple of announcements. Ted, if you could go to the second slide. We've got a few deadlines coming up that I just want to draw your attention to. On the 20th of September, we have a timeline to tell us if you would like to use your travel bursary for your partner, your UK partner, if you're a Turkish company, to visit you in Turkey. Also, 20th, in 2 days' time, is the date to finalize your partnerships and consolidating that. If you have questions about that, please do email Daria and myself. Also, reviewing and prioritizing your investor list, which you will receive, we have received, is also the 1st of October. And sharing with us your pitch decks is also the 1st of October. Again, if you have questions about this, please do email myself and Daria. We also have our second webinar with a law firm. If there are specific questions that you would like to have answered regarding anything to do with the state of partnerships, IP, anything that would be useful to ask a lawyer, please do send those questions. We want to be able to make this webinar tailored to your needs and your questions, so the sooner you send us those, the better. In this webinar, if you can please also mute yourself, it will improve the quality of the webinar in terms of sound. And please ask your questions via the chat. I will collect your questions and then pass them on to our guest speakers. And as you all know, this webinar is being recorded. Next slide, please. So for this webinar, our special guests, some of you have already met. We have Erman Turan. He is our T-DEB advisor, and he's also an angel investor. We also have Ted Fjellman, who is the chair of the advisory board. And I will be moderating this webinar as well. So now, with further ado, I will pass it over to Ted to introduce himself.
Okay, well, hello everyone. Thank you for joining. I'm Ted Fjellman. You should very briefly see my image come up on the video if that's enabled on GoToMeeting. I'll just say hi for those of you I haven't met, but I think I have met most of you. I'm the CEO of a biotech company in London. We've raised $22 million to date from 3 venture capital firms. I'm also the chair of the advisory board of Tekiu, as Cindy said, and was one of the co-founders of Tekiu some years ago. So today I'm going to try and help you to prepare for meeting investors from the experience I've had meeting investors all over the globe, and the 3 investors I have currently are from Europe, the Middle East, and Asia. So I have some experience to share there, and of course Erman will share his experience as well. So I think the video did not work, so I'm going to turn it back off again. Right, so I hope everybody can see the slides. I'm moving on to the first of my just overview of giving you the contents of what we're going to talk about today. So I will help you to understand what types of investors are out there. You can of course ask more questions about that at the end, but also specifically we're going to be focused on whether they are a good fit and how you find out if they are a good fit for you, because there are many different types of investors out there who are all doing a great job but might not be doing the right thing for your company at your stage. Then we will look at what investors are looking for in a pitch. And what we mean by a pitch, of course, is a slide deck or a presentation of your company. So what do investors want to see in such a presentation? Then I will hand it over to Erman, and he'll talk about the understanding the investment cycle, and that's from an investor's point of view, how they invest and what stages they're at. That's important for us as companies to know, so that we again enter into the investment cycle at the right time. Then we'll speak about presenting your company and give you an overview of some of the common mistakes that people make when they pitch and how to avoid those. Finally, Cindy will share with you some investor lists and resources that you can get more information from. All right, so what do you ask an investor to find out if they're a good fit for your company? The most important thing is to find out if they're a geographical or thematic fit. And every investor has geographical limitations, has thematic limitations. There's no investor that invests in absolutely everything everywhere. And if they do, then they will be a bad fit for you anyway, because that means they won't have specific knowledge. But the most easy question to ask from the beginning is, do you invest in the geographical area that or my company is situated in? Many investors will focus on areas that are close to home, so that they can easily travel there and they can actually, join board meetings or sometimes even join operationally in companies for some of the time. So they want to invest somewhere that's easily accessible for themselves. Others actually have very strict limitations because they've taken in money from agencies or from pension funds or from various backers that have reasons to invest only in certain geographic area. Sometimes that could be an investment fund that's linked to a university and is only allowed to invest in the region that that university is present in. Or it could be that they are a strategic fund that's trying to help the country to revive or to get a new industry set up. So that's important to ask, what geographies do the investors invest in? The second question is around the theme, of course. So many investors, in my case, I'm in the life sciences, and I think many of you listening are as well. You will very much know that an investor that invests in medical technologies and diagnostics often does not invest in drug development, and vice versa. So that's the same thing in environmental technologies or in smart cities. People focus on very specific subsets because a good investor is investing in an area that they understand very well themselves, and they usually are relatively small teams with high expertise in one area, and they will stick to that area. So you want to find out very soon if they have had companies like yourself in their portfolio before, if they have a background in your area, because what you really want to find is someone that is competent in their investment, and it's often spoken about as competent capital. That's what you're really looking for. The second bullet on this slide talks about the stage of investors. So there are investors that invest in company formation, meaning they might take a project out of a university and set up a company from scratch. There is no company set up yet. They put in the management team, they do all the registration of the company and so on. And that's common for angel investors to do. It's even common for some VCs that invest in very early risky stages to do that, because they have a lot of control over how the company is built. But in your case, most of you who are listening, it won't be relevant because you've already formed your companies. You don't want to have an investor that is interested in company formation per se. You want someone who's interested in later stages, like early stage, late stage, or even growth stage. So seed is another level. So if investors say they're a seed stage or company formation company, investment company, then they usually go for very small amounts of money at very early stage. VCs that say they invest in Series A or Series B, that usually means that Series A is usually, in my space, preclinical or pre-prototype in other spaces, whereas Series B is where you already have a prototype in place, or maybe you've done a clinical study, you have a proof of concept of some sort, and now you're building up to really make a partnership happen, or to register a prototype or a drug for late stage development. Late stage or growth stage refers to a stage where a company usually has revenue of some sort already. They may not be profitable as a whole as a company, but they already have some revenue. So that means the VC comes in and sees, this is a company that's capable of selling something. There are consumers or customers out there that are willing to pay for the product that they have, but they just need to scale up their processes. They need to improve their manufacture and so on. And that's usually late stage, growth stage. Part of that, people will throw out terms like mezzanine round or obviously IPO, most people have heard of, initial public offering. A mezzanine round, or if an investor says they are a mezzanine investor, that usually means that they tend to invest in companies that are public, but they will invest in the very late stages of private companies. In other words, they'll put money into a private company that's very close to going onto a stock exchange and doing an initial public offering or IPO. Finally, you've got the private equity investors, some of whom do get involved in mezzanine rounds for sure, but they also, some private equity firms purely invest in post-IPO, meaning they invest only in public companies. I think only a few of you listening here are public companies. So if you hear an investor says they're a private equity fund, that's probably not for you if you are a private company. They're probably too late stage. Okay, moving on to the next slide, we're still asking a question of whether an investor is a good fit. So now you already know they're a good fit from a geographical and thematic and a stage point of view. What you now want to find out is, do they actually have money to invest in you? So you want to find out, do they have funds that they are actively investing from? And what do I mean by that? I think Erman is going to speak a little more about this too, is that investors have funds. They raise a certain total, say $100 million, and they invest maybe in 10 companies or 25 companies. If they have $100 million and they invest in 10 companies, they're typically putting 10 million into each company, although of course it will vary a little bit. But they don't put the 10 million into a company in one go. They put some in, they put in some later, a few years later, to help the company to grow further. And what this means is that a fund is in different stages of their life cycle, with early stage being a lot of investment, and late, maybe towards the last 2 years of a fund, you're no longer putting any money into any new companies. You're only putting money into the companies you already invested in. So if you come to an investor and you can see on their website they have a fund and they have many portfolio companies, you want to find out if they still have an active fund and if they are actively investing from that. Otherwise, obviously, the only reason they're speaking to you is to fish for information. They're trying to find out, they're using you as a free source of intellectual or competitive intelligence. So definitely ask them if they have a fund that they're actively investing from. How do you find that out? You can ask, what age is your fund? So is it in the second out of 10 years? Then you know it's a healthy fund that they're still spending money out of. So you can ask, how many years does the fund have left? If it only has 1 or 2 years left, then that's not a good thing for you, and you probably don't want to continue to speak. You obviously be professional and everything. But finally, I would say a term that many people use and have heard is evergreen. So some investors will be evergreen, and that means that they don't have backers in their own right, or maybe they'll have some backers that are very generous or have a big foundation, but generally it means that the investor themselves have money that they have a company in the background that is making a lot of revenue, and they're investing out of that. So they do not need to return capital to any backers within a certain amount of time. And that's an investor that's very good to have if you're a company that doesn't want to think about an exit within 2, 3, or 5 years. If you want to keep growing, then an evergreen fund is a very good investor to have. Active fund simply means it is, as I said above, a fund that is still actively investing. Okay, moving on to the last slide of what is whether an investor is a good fit. So if all of the previous things are right, the geography is right, the theme is right, they're actively investing out of a fund, or even better, they're an evergreen fund, you still have a few questions left, and that is, how much do people invest? I mentioned the example of a $100 million fund. You might have a $100 million fund that invests only in 10 companies, 10 million each, or maybe you'll have a fund that invests in 25 companies and they get 4 million each. Now, that makes a difference because you want to know how long can this investor help support your company. So you want to find out, and you usually ask, what is your typical ticket size? And a ticket size usually refers to the total amount that an investor will set aside to invest in your company. Now, again, they will not put all of that money into your company in one go. It's very common for them to tranche money, meaning they commit to put, say, 2 million or 4 million into your company, but they'll only pay out 1 million upfront and then 2 or 3 or 4 million later. So they want you to reach certain milestones before they give you all the money. On top of that, people also reserve capital for the future. So they will put a certain amount of money in and then say, if there's another round of investments, so let's say an investor comes in at a Series A or a seed stage, they'll put in 2 million, but they'll, in their fund, reserve capital to join another round of funding where you as a company bring in yet more investors. And they want to keep their pro rata share, or they want to keep their amount that they own in the company the same. And in order to do so, they must have money reserved to put into the company in future rounds. So that's two questions you should ask. What is your typical ticket size, and how much capital do you reserve for follow-on investments? Another common question is to ask whether an investor will lead or follow. Mostly, well, obviously all investors follow, although some always prefer to lead. The reason you want to find this out is that you want to have a feeling for how much control this investor would like to exercise over your company. If they lead, then that means that they really want to dig very deep into you. They're going to do a deep due diligence, and they're going to be involved a lot in your company even after the investment is done. If they follow, then you know it is an investor that most likely is only going to join the round of investment if you find another lead. There's always got to be one investor that leads, and that investor is the one that will spend the money to really dig into your books and into your science and find out if your company is worth investing in. And the other investors will trust that lead investor and follow. They'll do some of their own due diligence, but a lot less. And finally, some companies have a certain goal for the percent that they want to own in a company. And I think that's important to know early on, because it helps you to understand how much you have to give up. So some companies have a minimum amount they want to own. They want to own a minimum of 10% of a company, for example. Some investment companies also have a maximum amount, and that's because of risk spreading. They don't want to put all of their money into just a few companies. They want to have a small share, maybe maximum 30% in any company. So even though they might lead, they might still have an upper amount that they're allowed to put in. And that also is important for you to know for future rounds, because it means you're going to need to get other investors on board in the future. Otherwise, the current investor can't put more money in, because they will exceed the percent that they're allowed by their own articles of association to invest. I hope that makes sense, but ask me about this if you have any questions at the end of this webinar. Okay, I'd like to now speak about the next slide here, what investors are looking for in a pitch deck. And we've put up here some titles or headings that should be part of your pitch deck. And the most important part of your pitch deck is the team. It always comes up front. The only reason it wouldn't go up front is if you basically don't have a team. If you are a one-man company with very few people involved, then the team can go a little later on. But even if you are a one-person company, you probably have some advisors, you probably have some people working for you in terms of consultants and so on, and you can then leverage them and include them in your team slide. Investors invest in teams. It is by far the most important aspect of any pitch deck. And the problem is the most important thing to show up front, and what your problem is, the problem that you're solving is. A lot of people in pitching make the mistake of immediately talking about the solution. They talk about the technology that they've invented, and they've invested their time in. But actually what you need to do before you talk about the solution is say that you are working on a real life problem that people around the world have issues with and that needs solving. And when you have spoken about the problem, that's only then you'll speak about your solution, and then of course speak about the market, that actually this is a solution that it can address the problem in a lot of different places around the world with a lot of different people wanting to buy it for a good price. And then and only then can you go into more details of the product, characteristics of your products, maybe some details about the manufacturing. Maybe your innovation is around being able to make these more cheaply or in a different way so that you have a higher quality product. That's when you would bring that up in conjunction with the solution section. What we mean by traction is, has your product attracted any interest by others in the past? Have someone maybe already paid for your product or service in the past? So in other words, has your product or service had attraction in the marketplace? And that could be anything like a hospital that has agreed to test your product and it has worked and they've given you a nice feedback for that. Or it could be that you have had some, you've passed a regulatory hurdle. So in other words, you've proven that some regulation or CE marking or something like that has been achieved. And after you've spoken about traction, that's when you can speak about competition. Now I'm starting to get into the landscape or into the area where the exact flow of the titles is not that important. You could have competition right after product if you want. This is each of you has to individualize your pitch deck. But what I said at the beginning is team and problem, that really should be right up front. Anyway, let's move on to competition. Competition is important. No pitch deck is complete unless you show that there are others trying to solve the same problem. And now the worst pitch decks are those pitch decks where people say we have no competitors. That is an absolute red flag for investors. It's something that almost makes them feel sick actually when they hear it. They don't want to hear that. They want to hear that you say, yes, this problem that I'm solving with my product can also be solved with this. But then you say why that solution really is inferior to yours, or why yours is superior or will be superior. And there always are some solutions. I can give you an example. In the vaccine space, I work and develop vaccines. Obviously, even if there is nobody else that has a vaccine against the disease in the world, there are still antibiotics. There are still hygienic solutions to prevent people from getting the disease in the first place. So competition doesn't have to be companies exactly like yours. It can be other ways of solving the problem. And then you need to, of course, speak about the IP landscape, not just your own patents that you have or any trademarks and so on that you plan to file for, but also what other IP is out there. You cannot go into all the details because a pitch deck needs to be relatively short, but to show a little bit that there are others out there that are doing something, but that it's not impacting your freedom to operate. And finally, you need to speak about the financials and the amount being raised. So financials is your burn rate, how much you're consuming as a business and trying to do what you do. And then the amount being raised is how much you want to raise and what are the use of those proceeds. And that's a typical term as well. Use of proceeds is what an investor will ask you for. And what that means is you say, I want to raise $10 million. And for these 10 million, I'm going to do X, Y, Z things over the next 3 to 4 years. And that's what, it's going to get us to these inflection points. And that leads you on to an exit plan, which says, if we get to these inflection points, this is who I'm going to target. I'm going to try and sell to a bigger company, or I'm going to enter into some sort of partnership with a bigger company, or I'm going to go onto the public stock exchange and do an initial public offering or IPO. Okay, and what's most important to bring across in a pitch deck is what's here on the picture, is the passion that led you there. Investors do invest in teams, as I said. All of you that I have seen in the T-DEB program are extremely passionate about your companies. Don't forget that. Don't make your pitch deck too dry. Certainly not when you present it as a in person. When you send something by email, it should be very professional and actually slightly on the dry side. But when you're presenting as a person, bring that passion across with you because investors want to know that you're in it for the long haul and that you're going to take this company through the good times and the bad times. All right, I will hand over to Erman, who's going to speak about the investment cycle.
Okay, hi everyone. First of all, thank you so much for the introduction, Cindy, and thank you for the valuable info about the first part, Ted. In this slide, I will mostly speaking about understanding the life cycle of the investment, because one of the perfect problem and one of the perfect mistake that entrepreneurs do is they don't understand sometimes the investment cycle, so that they think after the first touch or after the first meeting, the VCs or angel investors are gonna just send the money that they're asking for. So I think it's really important to understand, first of all, the investment cycle. Actually, some of you got invested and some of you may already have in contact with VCs and angel investors. But the important parts that Ted also mentioned here is you have to understand their strategy and you have to understand what are they looking for. Of course, there are things that you are looking for, and of course, there are things that you don't want to accept in a term sheet or in an agreement. But first of all, you have to understand that the investment life cycle is taking some time. And it will require some time and energy, and you will be asked a lot of questions during the DD processes, like this due diligence process that they ask a lot of questions about your startup. And you have to be patient about that one, and you have to be really positive about what they're asking for. Usually the investment life cycle starts with an email or an introduction to a VC or angel investor. One of my observations led me that if you get introduced to a VC by someone who knows that VC or the angel investor, this investment life cycle starts in a little bit more positive way. So of course there can be a cold email that you can just directly send it to your VC or to your investor. But if you can find someone who can introduce you to this investor, will be a good start actually. The second thing that also Ted mentioned is you have to understand what strategy are these investors are looking for. I mean, their investment process. What are the strategies that they're asking? Some of the companies are openly telling their strategies, some of the VC companies especially, and they will start talking about okay, we have that much money and we will invest in that stage, and we would like to invest that much money to this stage, and we will not invest in, they can say, oil and gas companies. And if you're an oil and gas company, well, it's so hard that you can get investment from them. Even they will not reply your emails as well. So from first contact to transfer of funds, first of all, you'll just get in touch with the investor, and most probably they will just like you to send a couple of slides that Ted also talk about some of the info. I mean, it doesn't have to be really deep, but it should at least cover the topics that Ted mentioned a slide before. And that will be a good a hinge point. So if they really like it, and if you can hook the investors with that 10 slides pitch or 15 slides pitch, they will ask you to come and tell your technology, let you tell the technology and other business cases depending on your business. And the other one is you have to also check if that investment company or a VC or an angel investor invested in a competitor of yours. So most of the VCs will not accept any kind of engagement with you, but some might accept and try not to give any kind of confidential information to that one, and try to avoid these VCs as well. And after a couple of meetings, and if they really like you, and if they decided to go to a DD process with you, they will deep dive into your company. I'm not going to go to details about that one. And then after some time, they will give you a term sheet. A term sheet you collected is it can be a page or 2 page, and it's a binding agreement with you and the VC, which is stating that which they are stating for you is we would like to invest to you, and since our closure, since we transfer the funds to you, please do not engage any kind of VCs at all. You may also collect a couple of term sheets, and the couple of term sheets that you collect can be conflicted as well. And as an entrepreneur, actually, you should be choosing among those term sheets, and you should be choosing the best one for your company. I will just briefly talk about like the due diligence process, the DD process and timeline. It's just a couple of sentences. It's not just a couple of sentences that they will ask you. They will ask you a lot of questions. They will ask your financials, your business case, or your patents, or whatever you have in the company, and they will deeply go these documents, and they will collect all the informations that you can provide to them, and they will decide depending on that one. And during this DD process, again, some entrepreneurs make some mistakes. They just hide some of the information, but like the information has a tendency to get to the sunshine, and after some time they will like notice that there's a lack of information about your company, and they might just stop the due diligence process, and they will say, thank you so much, we don't want to invest in you. And we can go to the next slide. Okay, how to present, when to present. Actually, Ted tell that a little bit more deeper, but I will just say a couple of words around here. Less is more. Try to be brief and to the point. Don't put too much info to the slides. It's not a book, it's a slide. So try to like summarize your points in your slides and try to like understand them and make the bigger sentences with your mouth. So don't let the slides talk, do the talking with your mouth. And the mutual interaction, it's kind of like a back and forth conversation. It's not just you are lecturing to the VCs or just the opposite, they are lecturing you. It's a perfect mutual interaction, and try to be open. You can ask questions, nothing is confidential in that sense, and let them ask questions as well. And ask if they have any questions. And this is also really important. If you just encourage them to ask questions, because they also tend to have a lot of questions in mind when they're like investing the money to you, and they will also clear their mind as well. The other thing is, I think this is the first thing that you should do. Be honest, and don't afraid to admit that you don't know everything. Of course, there are things that you don't know, maybe one of the competitors or one of the products that's in the market, or you may not run a company beforehand, so that you might be lacking of some of the HR or financial or any kind of like skill that you don't have. And these are the reasons that you're also trying to get investment, because you would like to expand your team as well. We can go to the next slide. This is the perfect opposite slide that I told you, and not try to give these kind of slides to the investors, since this is not an investment pitch. We can do that mistake right now. I mean, one of the things is you have to show interest, and you have to show, and you have to tell them you're extremely passionate about this job. It's not something that if you don't get investment, you will just go to a white collar business or white collar job, and they shouldn't sense that one. And you have to be really thorough, and you have to pay attention to every detail that you're sending to them. Please and please don't write bad emails. Don't make grammar mistakes. Don't make any kind of like typos in your presentations. They always show a way that you are a detailed person, and you are really keen on, and you're really working on your slides or in your documents. Don't talk too much, and this is also really important. If you don't listen, if you don't take feedback, or if you talk a lot of time, they will also get pissed off, because you're not the only one who pitched them at that day, or you're not the only company with the same idea you pitch to them. Maybe some of your competitors came and pitched to them, and one of the competitors might have a worse technical solution from you, but their business case might be good and their attitude might be good, so that the investors the investors are a little bit prolonged, and they would like to invest to that company as well. And try to look a lot of pitch decks, and there are a lot of examples on the internet, and also Cindy had just did a great job and compiled a lot of documents for you in the links of this presentation. Try to check everything and try to check every kind of competitor slides. And believe me, there are a lot of CEOs and like a lot of people who are blogging about their company and who are writing a lot of confidential information about their company as well. Read them and learn them. They're also writing their mistakes. That's also a really good point. And try not to do the same mistakes that they are doing as well. And try to be honest in the potential risks. As I said, maybe you don't know everything, but you might have a SWOT analysis, or you might find some threats about your business, and honestly tell them. It's a good thing as well, because if you tell them, that means you also know this threat, and that means you will also take an action to eliminate this threat. And this is a really good thing for the investors as well, because when they ask about that threat, you will not be jeopardized in your conversation with them as well. And one of the other thing is the competition. It's especially when it comes to life sciences or other kind of like IP-based businesses, competition is really important, and you have to have a really good unique selling points, and you have to tell them that you have a really good solution. But on the other hand, what differentiates from your competitor is also a good approach. Try to put a logical and substantial evidence that we are better than these companies. And you have to also tell about your traction and the customers that you have already got. That is, I think that's one of the best part, because like if you start talking, our traction is growing 5% every month, or our revenue is growing 5% every month, they will listen a little bit more carefully, because traction is one of the first thing that they all look. Since this is like a new technology or a new innovation, nobody knows about the market conditions, but traction shows a perfect market condition, because tractions equals to customers. So if the customers are trying to buy from you, or if the customers like your product, you will most likely have more tractions in your KPIs. I just would like to summarize all these, and these are the common mistakes to avoid when meeting the investors. And I think I will be passing on the slides to Cindy or Ted.
Thank you very much, Erman. Thank you very much, Ted. Ted, before we just jump into the Q&A, can you pass me on to the next slide? Next slide, please. So many of you are familiar with your investor list. This is obviously one example. If you have not done this already, please have a look at your investor list and prioritize. You will see in this particular example on the left-hand side, in this case, there's already been a prioritization giving ones and twos. Please do that by the 1st of October. If you have questions again about how to do this, please let Daria and myself know. In the rest of this slide, which will be emailed to you, there are a series of links and resources that Daria and I have put together that we hope you will find useful. If we could go back to the Q&A, please. So I hope that this webinar has been useful and that you've learned something new. I'm sure some of you have questions, so we're opening up now to Q&A. And nobody has typed in any questions, so I'll open up the floor for anybody that has specific questions.
Okay, and I'm Ted. It's Ted here again. I can see in my chat box that Serkar, you have asked some time ago about being presenter. Was it something you wanted to show?
I guess not. Anyone else? Anybody have any questions? Anything they'd like to share? Any concerns they might have about investment?
Hello, this is Bahadir. Can you hear me?
Yes.
Hello, Bahadir.
Hello. Well, I have a question. Yes. What I understand from the presentation so far is that we will be pitching our company in front of the investor for the investment to several venture capital, several investors. But in the meantime, we found some UK partners for a potential R&D project. We traveled to London and we had some conversations, meetings. I couldn't relate these two. I mean, we have an already established company, we have some products, we have some customer traction. Yes, we can, come up with a, presentation deck, make a pitch to an investor. That is a possibility. But where does this R&D project stand? That's not clear in my mind.
Okay, Cindy, do you want me to take that one?
Yeah, sure, Ted.
Okay. Well, thank you for that. That has been a question that many others have asked as well. Of course, as you all know, or most of you will know, is that investors invest in companies. Very rarely do investors invest in projects. So the way we think that these ties together is that you have the opportunity to show that as a Turkish company, you have got traction and interest with a UK partner. There are many investors that will not invest in Turkish companies, but they will invest in UK companies. So either there's the potential for you to start a project together with the UK entity where the UK entity gets investment that then is passed on into the revenue of your company by and through a project. It could also be that there are investors that are willing to invest in essentially a new joint venture. So what can happen is that you and your partner decide that we have something really exciting here. This R&D project could lead to a new company or to a joint venture. And if there are seed stage companies or Series A companies, seed stage investors or Series A investors, they will be very interested in such proposals. So when you present at the showcase in March 2020, you should be presenting as your company, but you also present the partnership with your UK partner, because they want. It's almost like the traction portion that Erman and I spoke about, because unfortunately, as we all know, investors tend to stick to what they already know, and a lot of them don't know the Turkish ecosystem, so they are a little bit afraid of investing directly in a Turkish company.
Yes. Okay. Yes. Thank you.
Do we have any more questions? Anything that you'd like to ask, that you'd like clarifications on?
Yeah, I want to ask something. Hello, I'm Shafak.
Hello, Shafak.
I want to add to Bahadur about this issue, because you talked about the R&D project and some new establishment in the UK. Joint venture maybe. So now we are talking about the R&D new project about an R&D, and we negotiate with the UK firms about a new project. But I think at the beginning of this phase, we need to say that, okay, in the March 2020, we will also make a presentation to investors about our mutual future new firm, actually, isn't it? Because now on the UK firms only knows that we will do something together in a project, not in a kind of establishment in the UK or Turkey or anything else. Because many firms that I negotiated with, they focus on the project only, and they ask me how much money I need to spend or something like that. But we will not talk any kind of new establishment in the UK, which joint venture or anything else. I think it is hard to explain at the beginning of this project, but after that, in a 6 months later, we said that in front of some investors, we say that yes, okay, maybe we will build up a new establishment in the UK or something like that. Okay, it is. I think it's not easy right now.
Yeah, I can add to that yes, that you're absolutely right. If you come to when we designed this project, and Cindy and the team thought a lot about it, you can't go to a UK company with almost nothing in hand and say, we'd like to establish a joint venture. So the best way to do this is to start by doing some sort of collaboration, get to know each other more closely. But our funder that is funding this entire project is the Newton Fund and also Innovate UK, and their job, of course, is to stimulate small and medium-sized enterprises, like both on the UK and Turkish side, to grow and to form partnerships. What we would like to do is to also invite potential funders that are not investors, and also maybe in certain cases some of you have identified customers that are large companies that are willing to essentially fund a project or a development project. And we would like to, if you find those, I think Daria and Cindy would have told you that you can also express to us any companies, any agencies that you think would be interested in funding a project specifically. So to answer your question, if your UK company is not ready to think about a joint venture because at the first step they only want to do a joint R&D project, then your focus should be to find non-dilutive funding through agencies or non-dilutive funding through customer financing, and do a joint project that way. And that is absolutely within the scope of the project. So you do not have to. This webinar today is about finding an investor, but if you find that your partner or maybe even your own company is not ready for investment and you prefer to just look for non-dilutive funding in the form of grants and so on, then the focus should be on that area, and we can adapt and try to find funders to come to the showcase. Cindy, is that fair, or have I promised too much?
No, that is perfectly fair. It is three of the pillars that are supporting a movement towards a showcasing event: clients, potential clients, funders of other kinds, including grants, and those types of financiers, as well as investors. We've talked to some of you. If after looking at this, you know that investment is not really the route you want to take, or your company is not at the stage where you want to invest, then we will find alternatives for the showcasing event to make the most of it. We've got a question in the chat from Osgur Kaya. We have to provide an exit plan to investors. I would like to inquire about the buyback process as an exit option once the company starts making revenue. How does it work? Do the shareholders ask for a bank loan privately to pay for the buyback?
Okay, Osgur, as always, you have fantastic questions. This is quite an involvement here. Let me just read this again, and while I read it and see if I can answer it, there is another question by you also, Osgur, simply about the length of the presentation. So maybe Cindy, you want to answer that one?
I can definitely take that. So, Osgur, again, depending on the final number of partnerships that we'll have at the showcasing event, will obviously have a proper configuration closer to the date. But roughly, we don't want to make it too long. We've discussed with Erman what this could look like. Again, just as what he presented, less is more. The showcasing event will be an opportunity for you to present, so we'll probably have around between 5 and 10 minutes. But then after that, this will also be combined with what you had similar to your discovery trip, a room with tables where investors and other interested parties can come and speak to you to get more details from you, so you don't have to feel pressured that you have to say everything in your presentation. I hope this answers your question as well.
Okay, and I think I have a little bit, I've thought a little bit about the buyback question. So I think we're talking here about debt investors. That's a subset of investors that tend to invest in a company, and then if the company starts to make revenue over time, the company itself or the other shareholders within the company are able to buy back shares from the debt investor. Is that what you meant, Özgür? Is that the situation you're talking about? You're muted at the moment, but
He says partly.
Yeah. Can you hear me now?
Yes.
Can you hear me now?
yes, we can hear you now. Yep.
Perfect. So that is part of my question. And actually, some of the investors also have clauses in the shareholder segment that there's an option to buy back their shares, and they can see this as an exit option. So
yes.
also, it's possible to buy the shares of the equity investors as well.
Right.
But
right.
more or less,
Personally, I don't have experience from debt investors or any provisions like buyback provisions like this. Erman, do you have experience with this?
I mean, debt investing, especially like competing with the VCs, is a really some of them are new models. It's kind of like non-dilutive VC investment, as we say also. They're just giving you some loans, which means they're just giving the money, and they will collect that money depending on their revenue. I can send you a couple of blog posts about that one. Once, as far as I know, I tweeted that one. But it's a really new model around the VCs because they're not taking any kind of shares from your company, but they're only revenue sharing with you actually. And also, since this is kind of like a time limited thing, they will only share with you some percentage of your revenue, which is coming from sales. But of course, there are drawbacks and other things that you have to think about it, because it's kind of like a bank credit, but you don't pay any kind of interest, but you will also be paying maybe more than triple or fourth of these like loans. I can send you a couple of info about that one.
Okay, great. Thank you, Erman. That was good. I hope that will help. I will try to rack my brain a little bit as well and ask around if this is something that's common in the UK. But in my area, in the life sciences, this is not common. But that's simply, I think, because we are in the life sciences, a lot of companies are not revenue generating until the point when you sell the entire company. So so this is it's a different field. So I hope that Erman can help you to answer that question later with the blog post.
Okay.
Erman, Ted, I've got two questions for you. The first one is, Erman, can you tell us a little bit about pre-seed investment? And also, maybe either of you or Ted, can you tell us a little bit about investors investing in research from universities?
Yeah, sure. Shall I start on this one, Erman?
Go ahead.
So seed investors and actually seed investors and investors that like to invest out of universities are very much the same kind of investor. Angel investors are in that space as well. They will what they're looking for is really something exciting in the scientific field, something very revolutionary in the science space. They will actually be slightly less interested in the team because most likely the university spin out, it's an intellectual property. The founder is probably continuing to be a professor, will probably sit on an advisory board of some sort within the company, and these investors focus very much on building up a team from scratch. So they have a large network of people that they know that come in as interim CEOs, and then eventually they of course hire CEOs and a management team and a new chief scientific officer or whatever is required, chief operating officers and so on. So these investors exist a lot. We have good networks here in the UK. for such investors. The thing to know about them is that they tend to put in very little money in the beginning, because they are in such a risky part of the development of companies, that their business model is putting very little money in to do some focused experiments early on, and then sell off or get other later stage venture capital firms interested. That's really the model. I'm not sure if that answers your question. If you have anything specific about what you want to know how to attract them, then all I can say is we do have some of you in the life science cohort. You met Dave Perry from SETA, who's an angel network here in London and the southeast of the UK. They know there are angel networks. There are people we know that we can access, and hopefully we'll be able to bring some of those angels to the showcasing. Does that answer the question?
Yes, I think so. Yep.
Can you repeat the question you just referred to me?
Yes, of course. Can you tell us a little bit about pre-seed investment?
Okay. Well, actually, pre-seed investment is also like depending on the industry, I can say, because some of the pre-seed investments are equal to grants, especially when it comes to IP-intensive startups. The pre-seed investment is just a lab tests. They're just covering for the lab tests. But pre-seed investors are also like, I can give an example about like gaming. I know none of you are about gaming, but like in the pre-seed investment for gaming companies, they're mostly try to finish a product, finish a game, and try to test it in a small batch of people, around small batch of people. Well, I can give an example about Turkey. Pre-seed investment is especially in Turkey, when you look at the like IP intensive startups, there are like TÜBİTAK grants, KOSGEB grants, or some of the grants that they can get like a non-dilutive investment. But the other ones are, especially when you look at the pre-seed investment in Turkey, it's not really big. I mean, some of the pre-seed investments are around 250 Turkish liras. 1,000 Turkish liras, and that money is a little bit less for the IP-based or tech companies, I can say, in general. But some of the pre-seed, and it's extremely early for the investors in Turkey. So since it's really early, most of the startups go for the pre-seed investment to grants, like TÜBİTAK or KOSGEB grants in Turkey.
And it's very much the same in the UK as well. Pre-seed, generally speaking, if you are an IP intensive company, or especially in the life sciences or in any regulatory heavy arena, then usually you're quite dependent on grants early on. And again, I go back to the original question around who's going to be there at the showcase. We obviously will like to have Innovate UK there. They will be there, but also other funding agencies that might provide non-dilutive funding. And so if you are, but I think none of these companies that are listening at the moment have, maybe some of you are thinking of spin-outs, which is the right way to think. If you are thinking of doing a spin-out with a joint venture with another UK company, then you might indeed be considered pre-seed. But you are in a slightly different situation because you have teams, you have capabilities to do. So, you know, a joint venture isn't a completely new, untested company. It is, as the name suggests, a joint venture with capabilities already in place. So you will actually be able to access investors that are a little bit more mature, I think, because of the capabilities. You've all been selected because you are more established as companies.
Thank you very much, Ted. Thank you very much, Erman, and thank you all for joining this webinar. I hope it has been useful. If you have additional questions, please do email them to us and we'll relay them back to Erman and Ted. Again, please, just a quick reminder, please do send us questions for the next webinar. We want to be able to tailor it to your specific needs, make it as relevant as possible. And this is all for now, and we hope to see you at our next webinar. Thank you very much, Ted. Thank you very much, Erman, for the wonderful introduction and all of the information that you have shared today.
Thank you.
Thank you so much.
Bye-bye, everyone. Thank you.
Well, one more thing before everyone leaves. Maybe I'm just too late. I just sent you a couple of links, actually, so you can read about the non-dilutive VC, how to support a company more exclusively in the startup ecosystem. I just sent you 2 links about that one.
Okay, it's in the chat, is it?
Yeah.
Yeah.
Okay, we'll make sure to
good.
copy
Clear
those
bank
and
stuff. Okay.
add them to the resources. Thank you very much, and have a good rest of your week.
Thank you.